So again, welcome. My name is Rob Tacklin. I'm a senior associate here at Civitas Strategies, and I am a certified tax advisor coach with our organization. And today we're going over maximizing tax credits for Georgia childcare business owners and directors. First, a quick disclaimer. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. And the information in this presentation is designed to help parents, guardians, and childcare business owners take advantage of tax code provisions. The agencies and third-party vendors that have come together to provide this information are not providing legal advice, tax, accounting, or financial investment or advisory services, cannot promise or guarantee that your family or business will qualify or receive the tax benefits that are described, and have used reasonable efforts to ensure the accuracy of the information and materials presented. By participating in this informational session or training, you are acknowledging that you understand the purpose of this presentation as stated above. You further agree that this information should not be considered tax advice and that you will consult a qualified tax professional before using the information discussed. You further agree that you will not hold the Department of Early Care and Learning, the state of Georgia, Civitas Strategies, any other agencies or third-party vendors of the state of Georgia and successors legally responsible for the information they are providing and any materials they create or share with you. Okay, so a few quick reminders before we jump in. Please mute your mic when you're not speaking. Use the chat function for any questions that you have. Have a workbook or a notebook handy. And if you are using a notebook, I recommend you section off a little space called the parking lot so that if you have any ideas, thoughts, or things that you have to do later, you can put those thoughts and ideas right in that side of your notebook so that way you don't miss out on any of the content that we share today. And then also, please stay present and engaged, right? It'll be really important that you take as many notes as you can because we'll be going over a lot of information fairly quickly. Now, a little bit about Civitas Strategies. We've been doing this for a long time. We really love helping childcare providers like yourselves get from where you are to where you want to be. And we've been doing this all over the country and helped generate or increase revenue, reduce costs, mitigate risk, totaling more than $1.2 billion in combined impact. And that's something that speaks just to the work that we've done to be able to help people like you. Now, the Thrive Pathway is a little different from other business trainings that you might have been a part of. Instead of just teaching information, it kind of acts like a roadmap, showing the steps and supports that help you move from just getting by to really thriving. And so our approach, um, so our approach is primarily based on practical guidance. It really is built on the experience that we've had with providers like yourselves, and also it's really provider driven, where we take our experience, your experiences, the challenges that you've had, and other providers all over the nation, whether they're in centers or in family child care homes. We take all of that into consideration and really just try and share the knowledge and wisdom that has been gleaned from having these conversations. Our real goal is to empower you with the knowledge, wisdom, and expertise that we've gained, so that way you can use that to the best of your abilities and really get to where you want to be. One second here. So again, when you're looking at some of the information that we have here, what I want you to do is, just a second. What I want you to do is listen to the information that we're going to be sharing here as if you were um, as if you were going to teach this to someone else. When you go through this information, when you go through any content that you're going to be listening to, if you listen to it as if you're going to teach someone else, you're going to have a different way. You're going to share it a different way. Okay. So that's really the most important part here is being able to get everything that you can from our conversation. Now, um, there we go. So we're going to talk specifically about what are tax credits versus deductions? Why are some credits more powerful than deductions, or even how they can help work in conjunction with your deductions? We'll also talk about some common myths and missed opportunities that childcare providers like yourselves have had in the past. Now, let's start with the basics. Many people will mix up deductions and credits, but they function very differently. This matters a lot for small childcare providers, especially those operating on thin margins or with lower tax liabilities. Tax credit puts real money um, in your into your budget, while while also not only just it being a small percentage like a deduction. Okay. Now, here's an example in action. A deduction lowers your taxable income, but the value depends on your tax rate. $1,000 deduction saves less than $300 in most cases. Um, Now, a credit lowers your actual tax bill. It's dollar for dollar, and that's $1,000. That $1,000 credit saves you $1,000. Now that we understand how credits work, let's talk about why they matter so much for childcare businesses and why they're often overlooked. So tax credits aren't just technical details buried in a tax form. For most childcare providers, they're really survival tools. These credits can offer real relief by lowering a provider's tax bill or increasing their refund that can free up cash for payroll, supplies, or even just getting through a tough month. Now, more importantly, many of these tax credits are tied to common business expenses like hiring staff, expanding your facilities, offering retirement plans, or even paid leave. Providers are already spending in these areas, and credits let them get part of that investment back. Now, the best part is these aren't just for large employers. Many credits that we talked about today are specifically for businesses with fewer than 50 employees. This includes home-based programs. Plus, some are refundable, meaning providers may receive a payment even if they owe little or nothing in taxes. That's especially helpful for providers who operate close to break even or reinvest most of their revenue. Lastly, tax credits aren't just short-term help, they can also support long-term sustainability. Whether it's offering benefits to retain staff or reducing out-of-pocket spending, they give providers a little more breathing room. But despite all that value, many providers still miss out, and it's not always their fault. Let's talk about the most common myths and misconceptions that get in the way. Now, we hear these all the time from providers. They assume they're too small or they don't earn enough, right? Or that their tax preparer is already taking care of it. If you're working with providers, especially with those with fewer than 50 staff members, you can help correct these assumptions and make sure they're not missing out. So, for example, some providers say I'm too small, and that's false because many credits are specifically for small business. Some providers will say I don't make enough to benefit. Well, a lot of refundable credits still offer value even if you don't have a lot of income. Some people may say it's too complex or it's too complicated. Most of these tax credits only require one or two forms. My tax preparer would tell me. Uh, One thing that I've found in coaching providers is a lot of tax preparers, even though they've been doing this for a long time, don't always know to look for some of these. And also, if you think about it, the tax code changes pretty much every other year. And so whether it's a different administration or if it's a different senator or there's different representatives, the lawmakers tend to change the tax code year after year. And so a lot of times tax preparers, if you can put yourselves in the shoes of a tax preparer, a CPA or enrolled agent, or some any tax preparer, they typically run about 500, so anywhere between 250 to even up to 1,500 tax returns, both personal and business, between January 1 and April 15th. And so if you think about the amount of hours that go into it, a lot of times tax preparers are looking for the fastest way to get through your return, which can really help them make sure that they get more returns done because they're helping more people, but it doesn't always give you the most accurate return, especially if there are credits that you could be eligible for. We'll talk about that here soon. Now, let's jump into the state level tax credits that are unique to families and businesses in Georgia. House Bill 136, which was originally signed into law in May of 2025, creates three separate tax credit opportunities. I want you to think of these as different tools, each designed for specific situations. Each credit has its own timeline. Now, one side note here for your parking lot, if you're going to be doing anything for these, if you're going to be doing anything as far as making sure that you have the right information, you want to make sure that documentation is key, right? You want to have everything that you need documented. We'll talk about the documentation needs for each of these. Now, what makes this a good policy is that these credits address different needs. Families struggling with care, these costs, it can help them through the child and development care credit. Parents with young children who aren't in care yet can still get relief through the child tax credit. And businesses that want to support their employees get rewarded through the employer-sponsored credit. The most important thing for providers to understand is these credits can't be combined with each other, but they can be used strategically depending on a family's or business's situation. The first new credit is in addition to the federal child tax credit, which is a maximum credit of $2,200 for 2025. Georgia is offering their own version of this credit under House Bill 136. It's the Georgia Child Tax Credit. This begins in tax year 2026 and offers a $250 credit per child under the age of 6. This credit is intended to help offset the everyday costs of raising young children, regardless of whether that child is in child care. Now, it's important to note that this is a non-refundable credit, which means it can only reduce the amount of state taxes owed, not result in a refund. Only one parent or guardian can claim the credit per child per year, and it must be done through a written agreement or court order if there is shared custody. The second credit in House Bill 136 is Georgia's version of the Child and Dependent Care Credit, which applies starting for the year 2025. This credit is now equal to 50% of whatever the family claims on their federal return for child and dependent care expenses. The maximum eligible expense for the federal credit is $3,000 for one qualifying person and $6,000 for two or more. For example, if a family receives a $600 federal credit, they can receive a $300 Georgia credit. Prior to this, the child care tax credit let Georgia taxpayers take a credit of up to 30% of the amount they could get off from their federal income taxes for qualifying child care expenses. Again, this is non-refundable and cannot be carried forward into a future year. The main value is that it provides direct relief to working families who are already paying for care to work or attend school. So one thing to remember with a non-refundable credit, that means that if they don't owe anything, it's not going to increase their refund. Okay, it's not going to increase the money that they get back from the federal or state government. So it's very important to recognize. Non-refundable. Now, the final Georgia credit under House Bill 136 is aimed at businesses and employers who help pay for childcare on behalf of their employees. Employers who have never offered this support before can receive a $1,000 credit per child under age 6. If they've previously supported childcare, the amount is $500 per child. In both cases, the business must make direct payments of at least $1,000 annually to a licensed facility. This must be in addition to wages, not in place of them. Employers must apply through the Georgia Department of Revenue for pre-approval before claiming the credit, and the total statewide cap on these credits is limited to $20 million per year, and if applications exceed that amount, these credits may be prorated. This incentive is designed to encourage more businesses to begin offering childcare support and to sustain those who already do, with a higher credit in the first year to reward new participation. If you are considering this, remember that you have to apply to the Georgia Department of Revenue before claiming it. Oops. Now, this is where we begin transitioning to the federal landscape. The federal credits are available to providers across the country, and when combined with Georgia's new state credits, they can deliver even more value. So before we jump into the federal credits, um, let's take a moment to see if you have any questions that touch on um, the House Bill 136 tax credits. You can put those in the chat. Please don't come off the mute. Go ahead and put them in the chat, and I'll take a look at those here if you have any questions. Now, one thing while you are typing questions in, if you have them, if you don't, that's okay too. But most of the credits, two of the credits that we mentioned were to support the family, right? And the reason we're mentioning these here for in a room full of childcare providers is for you to be able to share that information with the families that you support. Okay. That last tax credit that I mentioned is really for employers and childcare providers if you are providing childcare services for your employees. Okay, so that's one that can potentially help you and your taxes directly, while the other two credits that I mentioned are really geared towards families that you serve. And that's important because if you share that information with them, they're going to see, if they don't know about it, they're going to really appreciate that you're providing this information to them, which can lead to better outcomes for you as a provider. Someone asked if this class is recorded, and yes, it is. Absolutely. Now, what is the Section 45F child care credit? This is a federal credit outlined under Section 45F of the Internal Revenue Code, and it's claimed using IRS Form 8882. This is sometimes referred to as Section 45F credit. Now, this is one of the most powerful yet underused tools for employers to support working families while lowering their tax bill. This credit allows businesses to recover, it used to, for anything in before 2025, so on before December 31st of 2025, it allows businesses to recover 25% of the cost of building or operating a childcare facility or contracting with a licensed provider. In addition, employers could also claim 10% of the cost of resource and referral services that help employees locate quality care. The credit is capped at $150,000 per year, so in 2025, and must be offered equitably. Equitably means it has to be accessible to all employees, not just executives or certain departments. And Ms. Kim, I do see your question about the difference between refundable and non-refundable. I'll clarify that here in a second, okay? Now, regarding the expansion of the Section 45F under the 2025 budget reconciliation, for any expenses in January 2026 and on, the credit has expanded. Small businesses are now able to claim 50% of qualified expenses, and the cap has increased to $600,000 for small employers. Large employers are able to claim 40% of qualified expenses with an annual cap of $500,000. Now, to give you some kind of perspective on who this is for, a small employer is considered any business that makes $31 million or less in a tax year. So a large employer would be any business that makes more than $31 million in a year. Now, this change makes the 45F even more accessible. Small childcare businesses can coordinate with local employers or CCR&Rs to access these dollars. The intermediary option is especially important because it allows third parties to handle care arrangements on behalf of multiple employers. This is a major opportunity for childcare providers and community employers who want to build or subsidize care. Now, how this works for you as childcare providers, we'll go through that in a second. It actually, uh, when it comes to childcare providers, if you connect with an employer and you create a contract with that employer through a partnership, whatever it is that they're paying you directly, as long as they're a small business, they can claim 50% of those expenses up to $600,000 for small employers. So that's a really big deal because now they're able to provide a benefit, a child care benefit to their employees at half the cost, as long as it's up to $600,000. So essentially making your care half off, but you still get paid the full amount. It's pretty cool. Now, I'm going to pause here to Miss Kim's question, clarifying the refundable versus non-refundable. A non-refundable credit means that it just reduces your tax liability. So if you owe money, then in taxes to the state of Georgia, then that tax credit that I mentioned earlier would only be able to reduce your tax bill. But let's say it reduced your tax bill to zero, and there's still additional. I mean, that'd be the limit. It could not go past zero. You would not be able to get anything back from the state of Georgia because of that tax credit. Okay, so hopefully that clears that up. Now, you're welcome. IRS Form 8882 is pretty straightforward when employers go to claim the 45F, as in Foxtrot, that tax credit. But again, documentation is key. They need to keep receipts and proof of licensing for that provider, and should also verify that the benefit was available to all employees, not just a select group. If you are attempting to do this for a partner, for like an employer partnership, you'll want to make sure that you guide them and let them know that in order for them to claim this credit, they should probably consider adding the child care benefit to their employee handbook and make sure that it's clearly communicated to all employees that you are their provider of choice for that child care benefit, and that if for some reason that you are full, that they may have to find other providers to assist, okay, so that they can still support that benefit. But if you have more questions about how to implement this or how this works, we should have some time towards the end to talk more about it, okay? Now let's talk about retirement. So with the Savers credit, it's another non-refundable credit that's available to adults over the age of 18 who are not dependents of someone else or students. The program will give you a credit worth up to 50% of your contributions to your retirement and up to $1,000 in credits. This will depend on your adjusted gross income and filing status, whether you're married filing jointly, head of household, single filing separately, or qualifying widow or widower. Now remember, your adjusted gross income is typically less than your total income, so even if your salary is higher than the limit, you may still qualify. This is specifically for an individual, okay? So I'm going to give you an example here in a second. But this retirement credit, again, it's 50% of what you contribute to your retirement, and it goes up to $1,000. Okay, so if you contribute $2,000, you can get up to $1,000 in credit. Again, it's based on your adjusted gross income. Imagine that Imani is a family childcare business owner and sole proprietor who made $38,000 over the course of the year. She put $2,000 into a simple retirement account, a simple IRA for her business. That $2,000 will save her three times over. First, she'll save 15.3% in self-employment tax because that $2,000 was not taxed. Okay. And then 12% in income tax, which is a total of $546. Second, she qualifies for the Savers credit, so she gets a tax credit for 50% of the contribution, which is $1,000. So in this case, Imani has saved $2,000 in her retirement, and after the money saved and the credits, the cost to her was only $454. That's pretty great. Now, the next one is the Secure Act, the Secure 2.0 Act, which was passed in December of 2022. It includes three powerful credits that make it easier and more affordable for small employers to offer retirement plans. Now, first is a startup credit, up to $5,000 per year for the cost of setting up and managing a retirement plan. Second is the contribution credit, up to $1,000 per employee phased down over 5 years. And the third is a $500 annual bonus for using automatic enrollment. Now, this is a practical way for a childcare business to support long-term financial security for their staff while reducing their tax burden. A provider will claim these credits directly on their federal tax return using IRS Form 8881. And on the form, you'll report startup costs, whether auto enrollment applies, employer contributions, and number of eligible employees. Okay. There is a cost to setting up a plan like a 401k or a simple IRA or a SEP IRA. So there is cost. Now, typically, so auto enrollment, if your employees are auto enrolled in this retirement plan, that also assists in getting that $500 annual bonus for using automatic enrollment. And then the number of employees and how much they contribute is also important to help with this credit. So imagine Estelle has a center with 15 employees and she decided to use some of her stimulus money to start a 401k. Her business is an LLC that declared to be treated as an S corporation, so the profit goes on to her personal tax return, which is taxed at in the 22% tax bracket, just as an example. Let's say Estelle contributed 5% of the salary of each employee, which came out to $1,560 per employee for a total of $23,400. Between the fees and the cost of her time to set up and have her bookkeeper help with the 401k, she paid $2,550. Between her contribution to the retirement and the administrative cost, Estelle paid a total of $25,950. However, Estelle was able to save money in three ways. First, since the 401k was new, she gets 100% of her administrative costs back. That's $2,550. Second, since her employees make less than $100,000, she can get up to $1,000 for her contributions per employee for a total of 15,000 because she has 15,000 employees, or she has 15 employees, for a total of $17,550 in tax credits. So third, she gets the deduction for the contributions and administrative costs, which saves her another $5,709. All in, Estelle's new benefit cost her $25,950, but she saved or received credits for a total of 23,259. So she really only spent $2,691. Plus, Estelle can share information on the Savers credit for employees, so they will receive their tax credit and a greater benefit. So, so with that, she was able to save a lot using the Secure credit, right? Secure 2.0 tax credits. Okay. So, if you have any questions about the Savers credit, please put those in the chat and I'll look to answer those. So before I jump into the new employee related credits. Okay. So seeing none, I'll continue. Let's talk about the work opportunity tax credit. Now, this is the federal government's way of saying thank you to employers who hire people that might have a harder time finding work. Now, this isn't about changing who you hire, it's about getting paid for the community-minded hiring you're already doing. And this is crucial to understand. WOTC, or the Work Opportunity Tax Credit, is a tax credit, not a deduction. This is a reminder that a deduction reduces your taxable income, but a credit reduces your actual tax bill dollar for dollar. If you owe $5,000 in taxes and you get a $2,000 WOTC credit, you now owe $3,000. If you're getting a refund, the credit would increase the amount of your refund. This program recognizes that small businesses like yours are often the first to give someone a chance, and it puts money back in your pocket for doing what's right for your community. Now, let's talk about who qualifies. SNAP recipients, who are people receiving food stamps. TANF recipients, which are families receiving cash assistance. Veterans, who are transitioning back to civilian life and need stable employment. Individuals with disabilities who are referred to your business through vocational rehabilitation. Individuals receiving supplemental security income, or SSI. People who've been unemployed for 6 months or more. Um, so maybe someone who lost their job due to like COVID or downsizing, and is finally ready to get back to work. Young adults between 18 and 39 from low-income zip codes. Now, these might be community college students or young parents. 16 or 17-year-olds working during the summer, and it has to be between May 1st to September 15th. Now, these are exactly the kinds of people child care providers hire because you know your community and you believe in second chances. The federal government wants to support you for making those hiring decisions, and that's why there's the tax credit. The credit ranges from $1,200 to $9,600 per eligible employee, and the amount depends on which category they fall into, called target groups, and how many hours they work for you. For most groups, that will be based on the number of hours in 1 year, but you can receive credits for second year wages as well as for employees certified as long-term family assistance recipients. Here's the best part. There's no limit on how many employees you can claim credits for. If you hire 3 eligible people in a year, you get 3 credits. That's real money that can help with expenses such as payroll or facility improvements. If these credits were to result in a tax refund, there's no stipulations on how you need to spend your refund. The choice is yours. So this is an example of one of the refundable credits. And to the question we had earlier, this does not just reduce your tax bill, but if your tax bill is zero, you can have even more money coming in as a refund. Okay. Now, when we talk about the total credits by group, because you might be wondering, well, how many can I get? Right? So most target groups like SNAP or TAMF, the maximum wages is $6,000. Um, so it looks like so based on the percentages here, um, if they work more than 400 equal to or more than 400 hours, 40% of what you pay them would be credited. Um, if they work less hours, between 120 and 399 hours, it's 25%. Okay. Um, so that's important to recognize. It's also important to look so looking at these different categories or target groups. You can read here if it's their first year, um, the total amount of wages if you pay them $10,000. So even if you paid them more than that, it's the maximum is that's considered is 10,000. So Ms. Kim asks if this wasn't claimed prior years, how can those employees be counted out? That's a great question. The answer is typically no. So you have a specific time frame. I believe it's 28 days after they've been hired to determine their eligibility. And then you have to apply using the WOTC tax credit application. Okay. So the way this works is once they're hired and they're on your payroll, then it's typically an appropriate time to ask the questions or provide them with the questionnaire about whether they've participated in any of these programs or if they have been unemployed as a veteran, right? Or if they're a disabled veteran, looking at those things, right? So it's important to identify that as well. Uh, one of the one of the target groups that we mentioned earlier was like 16 to 17-year olds, right? Or young college students that are looking to work while they're at school, right? So take a look at that, but look at the maximum wages considered, right? At $6,000. So that's $6,000. It's 40% of that 6,000 is what would be refunded, if that makes sense. The maximum credit is that $2,400. Okay. So now when it comes to uh, right, so I hope that answers that question regarding if it hasn't been claimed in prior years. But any years going forward, unless you just hired someone and you're in that 28-day window, then you may still be eligible for that credit. So here's some examples. A SNAP recipient, so childcare business hires Alex, qualified SNAP recipient at $15 an hour for full time. Alex worked 40 hours a week, 52 weeks. Turns out to be 2,080 hours. The wages paid were $31,200. And again, the credit is for 40% of the first $6,000 in wages if they work at least 400 hours. As you can see here, that Alex does qualify. And so eligible wages for credit would be 6,000. 40% of 6,000 is $2,400. So, and again, this is over the course of a year. And so it's important to recognize that because sometimes you might have an employee that comes in at one part of the year. Let's talk about students, right? They might work during the winter and then so they might work a little bit in January or even let's say they work in December timeframe. Well, then it'd be for the prior year, right? But let's say they worked for you in the summer, right? So from like May 15th to I don't know, August or end of August. That's one portion. And then let's say they come back in December or after Thanksgiving sometime and they work a little bit more. That's when it matters how many hours they actually worked for you, right? And you have to be careful too, because if they are underage, you can't have them work over a certain number, right? So be mindful of that. Now, again, in one year, the business can receive a tax credit equal to 40% of, in this case, the first $10,000. Okay. So it does matter which group they belong to. Okay. Now, the credit calculation is based on two tiers. If an employee works between 120 and 399 hours in a year, that's part-time work, and you get 25% of their wages back as a credit. If they work 400 hours or more, that's full-time, you get 40% back. Okay? And the credits only apply to first year wages. So you claim them once per employee. It's not every year. Okay. Now think about your turnover. If you're hiring new people regularly, which a lot of child care providers are, you're creating new opportunities for credits throughout the year. The key is knowing about this program and filing the paperwork on time. Here it is. So in order to receive the WOTC credit, you must follow the 28-day rule. This means you must submit your forms within 28 calendar days of when the employee starts work, and not 28 business days, it's 28 calendar days. There are no exceptions, no extensions, no appeals. If you miss the deadline, you cannot claim the credit, period. So it is crucial you have a foolproof system to ensure you do not miss the filing deadline. And this is why we recommend making WOTC paperwork part of your regular onboarding process, right alongside getting their I-9 and tax forms. You want to set a calendar reminder for every new hire. Now, the good news is the forms themselves are simple. The hard part is just remembering to do it within the deadline. Now let's walk through the actual process. Step one is identifying if you've hired anyone in the last 28 days. If yes, you still have time to file. If no, that's okay. You can get set up for future hires. Now, step two is screening for eligibility of new hires by asking questions like, did you receive SNAP in the last 6 months? Are you a veteran? Were you unemployed for at least 6 months? Step three is gathering wage and hour information that you should already be tracking. Total hours worked and wages paid before taxes. Step four is estimating your credit using the free calculator at civstrat.com. Uh, so let's see. You'll enter the employee category, hours worked, and wages to learn the amount of the credit you can receive, which would be between $1,200 or $9,600. Step five is completing the two required forms, IRS Form 8850 and the DOL Form 9061. So IRS Form 8850 and DOL Form 9061. Step six is submitting both forms online through the Georgia Department of Labor portal. Okay. And there are those form numbers there. Now, when it comes to submitting these through the portal, you'll want to make sure that you get there and do this obviously within that 28-day time frame. There are a few forms you'll hear about relating to the WOTC. The information included on both forms is very similar. One is for the IRS, and the other is for the Department of Labor. IRS Form 8850 is the pre-screening notice. This notifies the IRS that your business is applying for WOTC. The employee enters basic information like their name, address, social security number, and contact information. The employee then answers questions about eligibility, such as participation in TANF, SNAP, veteran status, all of the areas of eligibility we discussed earlier. You, as the employer, enter your business's identifying information and dates, such as when the employee submitted the information, when they were offered the job, when they were hired, and their start date. Both the employer and the employee need to sign this form. The DOL Form 9061 is titled the Individual Characteristics Form. This is where employees enter qualifying specifics to determine eligibility. An example of the information that would be entered is if an applicant is a member of a family receiving TANF benefits. They'll enter the name of the primary benefit recipient and the city and state where the benefits are received. A summer youth employee would enter their birthday. All the information that's required is fairly straightforward. For Georgia, however, you can go to the Georgia Department of Labor's WOTC portal. I'll put that here in the chat. And you can upload your applications, you can upload supporting documents, check the application status, and even print determinations once the application has been processed. Now, at Civitas Strategies, we've created a calculator to help childcare providers determine employee eligibility for WOTC. And so I'm going to also put that in the chat. So there are two links there in the chat. One of them is the the Georgia WOTC the Georgia WOTC application in the portal, and the other one is the civstrat.com Work Opportunity Tax Calculator. Okay, so you have that there. Now, as DECAL staff, your role isn't to answer every tax question, and you're not expected to give tax advice. But you are in a position to raise awareness and connect providers with the right, connect providers with the right tools. or really connecting other people with the right tools. Now, you don't want to underestimate the value of a warm handoff. When it comes to uh, when it comes to um, when it comes to getting the right information, feel free to talk to one of the business coaches. You can reach out to a tax preparer that um, knows tax credits, or even ask them, "Hey, I just went into a webinar and I heard about a tax credit that could really benefit me as a provider." Right? So you want to ask them about that. And even on the DECAL website that we just put in the chat, there are going to be informational articles that you can read to learn more about WOTC and how to qualify. Okay. So it's really important to consider, um, you know, asking these or going to these different parts of your library of information. Now, I want to take a moment to touch on any questions that you may have in the chat about the work opportunity tax credit before we move on to the family leave credits. I also want to give you a moment just to click on those links that are in the chat. And if anyone needs those links again, just let me know. Okay. So the 45S, as in Sierra, provides a tax credit to businesses that offer paid family and medical leave. This is a federal tax credit that covers between 12.5 and 25% of the wages paid during the leave period. Employers can claim this credit for up to 12 weeks of leave per employee per year. And importantly, your business does not need to be covered by FMLA to qualify. Um, so this the changes in the tax bill now make the paid family leave credit permanent. So to claim the credit, complete IRS Form 8994 and IRS Form 3800. They should be up here in the next. So, um, so to qualify or to claim the 45S credit, employers need a written policy that offers at least 2 weeks of annual paid leave for full-time employees, with at least half of their normal wages covered. Employees must have been with the business for at least 1 year and earn below a certain income limit. This credit can apply to both full-time and part-time staff as long as the leave is prorated. What it means to be prorated is that based on the day that, or the number of days that are covered by the benefit. Um, so, in other words, if an employer has is providing 2 weeks of paid family leave, um, and you have some sort of calculation showing how much leave they have accrued, and you're showing how much that they are paying, that you as an employer are paying, um, you'll be able to qualify for this credit. Right? You also need to show that the employee has worked at least 1 year for you. Now, when we talk about it being prorated, you may have an employee that has worked for you parts of the year in other years, right? And so it might take them 3 years of working for you part time um, in different years, right? In different amounts to show 1 year of employment, right? So that's what we mean by having it prorated. So now, not all leave types qualify. To count toward the 45S credit, the leave must be for one of 6 specific family or medical reasons, such as bonding with a new child or caring for a seriously ill family member. General vacation or sick leave does not qualify. These categories mirror those under the Family and Medical Leave Act, even if your business isn't formally covered by FMLA. So I'll read those here. Birth and bonding with a child, adoption or foster care placement, caring for a spouse, child, or parent with a serious health condition, the employee's own serious health condition, or military leave or caregiver leave. Okay, so this kind of leave or benefit that counts towards the 45S. Now, before I jump into healthcare, are there any questions in the chat about the 45S? Feel free to pop those in there. Seeing none, we'll go forward. Now, what is the small business healthcare tax credit? This credit is designed to make it easier for small businesses to afford health insurance for their employees. It can cover up to 50% of premium costs for small businesses and up to 35% for nonprofits. Now, to qualify, you must purchase your insurance through the Small Business Health Options Program or SHOP Marketplace. To qualify, your business must have fewer than 25 full-time equivalent employees. The average wage must be below around $62,000 annually, though this number adjusts every year. You must also cover at least half the premium costs for your employees and use the shop marketplace for your coverage. So what this means is if you're an employer right now and you are providing healthcare, um, some providers, I mean, some providers will provide 100% of the healthcare premium cost. Some providers will provide just 25%. This says you must provide at least 50% of the premium for employee-only coverage. Okay. Um, Now that again, it's for people that have fewer than 25 full-time employees. Um, so this is strictly for small businesses to be able to afford to cover healthcare expenses. Now, to claim the credit, you'll file IRS Form 8941 with your business tax return. Nonprofits will file Form 990T, even if they don't owe taxes. You can only claim the credit for 2 consecutive tax years, and it only applies to premiums paid for employees, not for yourself or any owners of the business. Now, the IRS has helpful information on this credit on their website, and I'll go ahead and put that here in the chat. Okay, so you can learn more about that. Okay. So finally, we want to share where to direct any follow-up questions. If you have questions about Georgia's tax credits, please email taxcredits.inquiries@dor.ga.gov. And I'm going to put that here in the chat. Um, and so if you have any questions about the Thriving Child Care Business Academy, please email thriving@decal.ga.gov. And that's